Our next question comes from Julith G. Julith says, I love your podcast and I've been learning a lot from you too. I have a question though, regarding some extra money I have sitting in a high yield savings account waiting to be invested. Should I wait until VOO is down a little bit before I start investing? I just feel like new all-time highs isn't a great time to start investing. Robert, do you want to take this one first?
I mean, this is an easy one. No, no, no. No, you should never wait. All jokes aside, you should never wait and try to time the market. I had a gentleman jump on my live last night and said, well, I could time the market. And I was like, good for you, buddy. If you think you can successfully time the market, then that is just kudos to you. But the bottom line is this. In almost all situations, dollar cost averaging is the key to the win and how you should look at your investment strategies. You should never be sitting on the sideline with your money in some savings account making 0.0001% when you could be dollar cost averaging into the VOOs of the world and optimizing your wealth building strategies. We did a bit on an episode in the middle of 2023 where we talked about, and Austin might have the numbers in front of us, of what would happen if you missed the 8 best investment days of the S&P 500 over the last 50 years. And it was crazy the difference in return. You almost went from this 100 and some % return to zero or losing money just by missing the 8 best days or 9 best days. And that is just a testament to not trying to time the markets and just being in the markets. And we always say that, don't time the market. It's time in the market, not timing the market. And it's just so important to understand that, especially when you're talking about VOO and the S&P 500.
Julith, just so we're on the same page here, in my investment accounts this morning, as we're recording this, I invested another $2,000 in the S&P 500 today, and we are at all-time highs. And you know what I'm going to do next month? I'm going to invest another $2,000. And you know what I'm going to do the month after that? I'm going to keep investing more, right? Because 2 reasons. One, I have a very long time horizon. We know over the short term that it's pretty unpredictable. I think Robert and I would agree on that, and you as well, Julith. However, over the long term, several years, decades, we know which direction the stock market's likely going to go, and that is up and to the right. So if you do not need to have this money over the next 60, 30, 90 days, whatever it is here, and you have a long-term investment horizon, then invest the money into the markets toward your retirement, right? And if you can't grasp that for some reason, if it's hard for you to understand and maybe you just have a lot of emotion with it, try and automate the process. If that is, getting the auto invest feature turned on Public or Fidelity or whatever broker you use, but kind of automate that where it happens behind the scenes. Maybe it comes out of your paycheck, kind of like the 401k does whenever we get paid, right? That has helped a lot of people take fear and emotion out of investing, just automating that process away. And you'll soon see, Julith, that over time, if it's months or even years even, for example, I remember I had a friend here who refused to invest during 2022 and 2023 because they thought there's no way the market's going to keep going up. The economy's bad, this, and that. And they just didn't want to invest. Well, what I did is I turned on my auto invest. I just kept auto investing. And my returns outperformed the market. I think it was 35% last year in 2023 is what I returned to my portfolio. Now, I did that without even looking, right? I just picked my index funds. I didn't even care. I just kept going. And now I look back and say, well, that was cool. Let's try again this year, right? Let's try again. Keep going and going and going. I don't care where the market is right now. I believe in American capitalism, and I believe in these long-term index funds that Robert and I have talked about for several months now.
Yeah, the easiest way for everyone listening and following along to understand and a practice that you can implement right now in seconds is to learn to zoom out. Every day people message me by the dozens. Did you see Bitcoin today? Did you see Chainlink is down 12% today? And sometimes I'll be like, no, I don't look at the day-to-day prices. I don't have a reason to. But the easiest practice you can do is go to a browser, type in Bitcoin price, click on it, and instead of looking at all the red you see for the last 7 days, click on year to date, click on 5 years, click on 10 years, and zoom out, and you can see that it's just this, always going up and down, but to the right. Once you learn that practice, it will calm you down. It will get you to understand that you don't want to look at the minutia in this day-to-day battle because you'll drive yourself crazy. If you believe in a sector, you believe in an investment, you've done your research, then stop worrying about the day-to-day fluctuations because it shouldn't matter in that long-term horizon. It's just way better to zoom out.
I couldn't have said it better myself, Robert.